So hey everyone, glad you could make it. Welcome to our HK Wealth Management third quarter 2020 recap and market update. We're going to be going through this. We'll try and keep it as short as possible. We want to get you guys out of here and on with your days. We'll be going over a little bit of where we stand right now, a little bit on the economic side, and then getting into the market structure and these extremes that the market's currently in, and ultimately where we're more likely than not headed, and then also some opportunities or areas of opportunity that could potentially be beneficial moving forward. So I'm Corey Reeder, Chief Investment Officer with HK Wealth Management. And as you see on this first slide, hear no risk, see no risk, speak no risk. This is the mantra of Big Wall Street, and everything is always based on eternal sunshine, rainbows and unicorns forever. And, there's always a reason to be invested and stay invested in the markets. But obviously, as we learn time and time again, that is not the case. Getting into, as I showed in the title, the SoftBank Gamma Squeeze. So what that is, we'll hit that right off the bat. Thinking about the run-up that we had since the crash back in March, and then this enormous rally that we've had since then. Remember back in July and into August, where markets were just perpetually going up every single day. And people were scratching their heads trying to explain what was going on. Well, what it was, SoftBank is a big Japanese conglomerate. These are one of the big boys in the world as far as total money in markets, and they buy up a lot of other companies, as well. But what they were doing was they were trading heavily. They were trading tens of billions of dollars of leveraged options plays in the markets, and what that does is creates gamma in the markets. We won't get into the definition of what gamma is, but effectively, the more options they bought, it forced the big broker dealers to hedge and offset the risk that they were being exposed to by the moves by SoftBank. And hence, what it creates is that momentum begets momentum, and the more buying that occurred, the more it forced the broker dealers, the big Wall Street banks, to continually to buy more, which kept forcing markets higher until we hit the end of August, and that all stopped. And of course, we had the pullback in September. But gamma works in both directions. When you get into a negative gamma situation, selling begets more selling as well. So it is a double-edged sword. But that's what was going on towards the end of the end of August. But beyond SoftBank, SoftBank, sure, it was a player. But you'll see this was where that big spike and blow off top was as a result of what SoftBank's manipulations in a very illiquid market, because trading volumes have just been anemic compared to historical averages. But more so than that even is, don't forget, the Federal Reserve pumped $3 trillion of extra liquidity into the markets back at the bottom end of the late March of this year. And look at the trend line of the NASDAQ and the actual global central balance sheet. So as these central bankers provide more liquidity, they buy up more assets, and their balance sheet obviously expands, but you'll see that the alignment of the balance sheet expansion with the movement of the markets is once again tick for tick. I mean, this is something we have talked about ad nauseum over multiple, market, quarterly market updates. So these markets are completely manipulated. And as you can see, when looking at the actual earnings of the S&P component companies compared to the S&P market itself, you'll see that the S&P has recovered from that all-time low and ran up not as high as the NASDAQ has. This has been dragged up by 5 big technology names. But look at the disconnect with the actual forward earnings per share consensus. See, if you line them up, and this was the consensus through the end of 2019, then we have the crash. Look at the disconnect between the two. And this would imply, on a dollar for dollar average, that the S&P should be trading closer to the 2000 level just over this short time frame. Now, remember that number of 2000, because that's going to come up again later on in the presentation. So thinking about this bubble that we're currently in, what we're looking at on this chart is the S&P price to sales ratio. So these are, effectively the total sales that the S&P component companies are doing compared to the actual price of the S&P itself. And if you look back here in 2000, it hit its, at the time, record peak in the dot-com bubble. And then, markets were completely overvalued, as you know, and then things adjusted back down to reality. We had the 2007 run-up, which was more of a real estate bubble, but everything imploded after that and crashed down to these lows. Look where we are today. We hit that all-time peak back at the beginning of 2000, well, I guess that was 2018. There was, in January, then we had the December crash, the run-up into February of this year, and then the crash in March. And look, we've blown out beyond any sort of sense of rationale. We're in an even bigger bubble today than we were in the dot-com era. So, but you know what? As Wall Street would say, nothing to see here, move along, everything's fine. Obviously, it's not. So, understanding this, what this chart is showing is the 10-year correlation between the market and the actual economy, GDP. So, and what you'll see is right here, this is the first time ever. Central bank interventions have created the largest break in correlation between the economy and market prices ever. And this is the first time the Federal Reserve has been able to blow a bubble inside a recession. These are just, ridiculous things that are going on right now when you consider what's truly going on in the economy. But this is a first in the existence of a negative correlation. We're totally distorted and disconnected in any way, shape, or form in the markets compared to the actual reality of the economy and what's going on. So thinking about bubbles, looking at the South Sea stock. So this was a bubble that occurred back in December 17-18 up till December 17-21. And look who's involved in this bubble, Sir Isaac Newton. Now, yeah, he's a pretty smart guy. He's a smart cookie. He's got a couple of brain cells to rub together, but that doesn't mean that human emotion doesn't take over and take control of people. So, today, investors today would be wise to always ask themselves whether the investments they are making are at values justified by future profits and not just by the hope of selling to some future greater fool. And that goes to the basis of the greater fool theory. No matter how high a market goes, I'm willing to buy it because there'll always be someone who's even more foolish than me who'll pay a higher price for it. But look at Isaac Newton's track record. Back here in the start of this bubble, he bought a bit down here and then went up about 150% or something, and he got out. He was happy. But then guess what? His friends stayed in the market and they were all, chewing on his ear and telling him what a fool he was for not being in and enjoying all the wonderful gains. And so Newton jumped back in with a whole lot of his money. The bubble peaked, collapsed, and guess what? Isaac Newton exited broke. And that's what happens. That's the euphoria. That's the retail euphoria that occurs at the end of all these investment markets, is where the big players, the smart boys that bought in low, and they get out when markets hit all-time highs. But unfortunately for your average investor, they're the ones that get suckered in by the emotions and the euphoria, and they end up buying near the peak just to watch their life savings disappear as the markets collapse. So getting on to where the actual economy is, like I said, we're going to touch on this pretty lightly. But this is the University of Michigan consumer sentiment. Now remember, everyone was talking about a V-shaped recovery. Everything was going to bounce back and it's going to be wonderful again, and it would be like we didn't miss a beat. And sure, we've seen some things like real estate, pending home sales are crushing it higher, but think about all the adjustments in lifestyles. People are selling up and moving out of Dodge, moving out of high-tax states, moving out of big metropolitan areas and getting out away from the congested areas to avoid the virus or any other number of factors that are going on. So, some of these things you've seen out there are, other items are because of all the stimulus that was flooded. $3 trillion from the Federal Reserve, another 4 to 5 of fiscal stimulus coming from the government, but effectively a sugar high. This consumer sentiment, we saw the plunge in March, and all I got was this lousy T-shirt. This is where we're back to as we stand today. And remember, the US economy is 70% consumer driven. And if consumers aren't consuming, then there is no real economy. Obviously everything's fabricated with all the money and debt that's been printed out there, but this is the reality of what's going on in our consumer driven economy. So as a result of that, you would then understand why our US industrial production unexpectedly tumbled in September. So it was already in a downward decline, and then March hit, February and March hit, and it plunged. We had a little bit of a V-shaped recovery, and look, it's rolled over and turning lower again. So, does that mean the V recovery is over? You've heard all these people talk about K-shaped recoveries or W-shaped recoveries, and this is just the reality of where things are. If consumers aren't consuming, then there's nothing to produce. Build it and they will come. Well, no, actually, you've got to consume it first in order to build more to cover what's been sold. And this is the reality of what's going on. Looking at jobless claims, look at the spike that occurred back in March once again, and sure, we've had a recovery from there, but look at this higher level. These are new jobless claims every week, and these claims have stayed consistently higher around the 800,000 jobs level of new people being unemployed every week. And when you look back at this, this is 4 times higher than the pre-COVID levels of people who were losing their jobs. So, nothing is fixed within the economy when looking at this chart. Looking at the overall, employment numbers of the continuing unemployment, this red line, when you hear the Bureau of Labor Statistics, they'll quote numbers saying, back at the peak, we got up to 20-something million people and now 11 million last, on the previous report. And then just today, I believe this one came out and it's saying it's down to about 9 million of continuing unemployment. That's just state claims. And so the Bureau of Labor Statistics, they always cherry pick the data to make things look better than they actually are. So when you add in the additional unemployed people who are on pandemic unemployment insurance and pandemic emergency claims, and look at this, the pandemic emergency claims, this blue region, have been continually increasing over this entire period. But bottom line, this whole bar graph are people who are unemployed at the moment, not just this red number. So the reality is not 9 million people of continuing unemployment. It's actually about 23.5 million. So as it says, take all this data with a pinch of salt. Now, continuing, so looking at the actual total jobs openings graph. So the labor market, US labor market is topping out. And job openings have posted their first monthly drop since the COVID crash. Now, in previous market updates, we were already going over and outlining this changing trend and this topping or rollover that was occurring in the job openings arena. Then, of course, it declined, the crash in March, the rebound, and once again, we've seen this now, the sugar high has worn off and reality is setting back in. But it's kind of interesting that this trend line is the exact point where the inflection came. So given all the other recessionary periods, yes, we would expect this to roll and continue dropping lower. Especially when you consider small firm bust accelerates as bankruptcies soar in September. So each one of these bars is a quarterly number, so 4 quarters per year. But looking here, the third quarter, this is the highest or the worst third quarter on record for bankruptcy filings. When you go back to 2008, the third quarter was only sitting down here around in the high 50s. We're actually up over up towards the 65, 67 level of actual companies that have filed bankruptcies. So with all these companies going bankrupt, what do you think is happening to those jobs? If these companies are in fact closing their doors and disappearing, then permanent job losses have continued to shoot higher. So understand, when a company closes its doors, those jobs, they're not there. They no longer exist to be re-employed into. So this is showing the real indication of what's happening in the labor market as all these companies go bankrupt and all of those jobs have disappeared forever. So if the jobs are no longer there, where are these people going to get re-employed into? So that's not a good sign in and of itself. And look, it seems like there's no break in the trend of this. And if we're hitting, things are just getting worse and worse. And going back a little ways, I've been talking about an oncoming 1929 style crash and a 1930 style global depression. I've been talking about that for a while. And of course, we had the crash in March, but all we did in March was kick the can down the road. We have so many more economic knock-on effects and things to deal with and work through, all the forbearances on rents and leases and mortgages and everything else that still need to be paid back on top of their ongoing payments whenever they do remove those moratoriums. So nothing is boding well for the medium to long term. And so looking at banks, this is the portion of banks that are reporting tighter loan standards. They're locking up and they're not lending anymore. This is commercial and industrial loans, lending to small firms, consumer credit cards, new and used auto loans, multifamily residential. This is all types of lending. And it looks like, this chart itself, this is coming through October are the markers here. So this is probably a little dated. Maybe we've seen a little bit of a rollover here. I do know loan loss provisions have been dramatically reduced, but all that's doing is opening up more exposure for those banks to get hit hard as the economic fallout continues. But what's it matter to banks? They'll just get bailed out by the Federal Reserve once again. So speaking of bailouts, what this chart is showing is the percentage of US zombie companies. Now, what a zombie company is, it's a company that needs bailouts in order to operate. These companies are not generating enough cash flow to actually pay off their debt. They're barely able to pay the interest payments on their ever larger amounts of debt that have been piling on top of these firms. And so the only way they can stay afloat is getting bailouts, or think about the Federal Reserve in March. They started buying individual bonds from directly from companies in the public markets, and also bond ETFs. And there's been a massive amount of new debt issuance from all these companies across the US. Why? Well, because the Federal Reserve and the Treasury have been backing them up and buying every piece of bond and debt that they want to issue. And actually this is through 2020. So continue to October of this year. And this trend line, this goes back to 2000. This is not a new phenomenon. This has been growing and building over the last two market cycles. So we could very well be up around the 23% range by now, 21 to 23%. But talking about companies adding and layering on more and more debt, look at this. So this chart is showing your corporate debt to GDP ratio. So going back over the history, back as far as 54, this ratio is only about 23%. You had a run up and a build into the 74 crash. You had the 87. This created Black Monday. And now look, as we've gone along into the dot-com crisis, the corporate debt went higher. Into 2007, 2008, the debt went higher. Look what's happened here. Just so far this year, corporate debt has massively spiked higher. How is any of this? We're up around 57% corporate debt. Of the total economy, corporate debt makes up 50% the size of the US economy. That's how ridiculous things have become. But This is the Federal Reserve backing up these zombie firms because there's no actual economic creation or activity going on. So none of this is boding well for the longevity and even in the shorter, mid, and long term for the economy or the markets, because this needs to be dealt with at some point. So moving on now, getting away from the economic data, that gives you sort of a summary and a recap of what's truly going on in the economy itself, and that we are not out of the woods. But looking at, instead of the economy or debt to GDP, this chart shows the total market cap. So this is the size of the entire stock market compared to GDP. Now, going back to the dot-com bubble, this ratio, the market was probably about 144 or 142% of the actual economy. And then we had the crash, 2007, and the great financial crisis. Look at where we are today. The market is 186% of the economy, of GDP. Effectively, the bubble that we are in now, just looking at this, we are twice as big of a bubble today than we were in the dot-com bubble. And we know how that ended. But, how could that end? I mean, let's look into some of the extremes that are going on in markets. So right now, no one cares about hedging anymore. So hedging is what we do with mitigating losses and moving to cash and avoiding those big drawdowns and crashes that occur in markets. But other ways to do that is what's known as short interest. So this is where people and fund managers and the like use individual stocks or ETFs as shorts. So think about when you're shorting something, if the market goes down, it makes money. So having a portion of their portfolios or their funds leveraged short reduces the losses when markets do pull back. But what you'll see as we've headed through the years and we get up to today, we are at, I don't know if this is a record minimal short position on funds, but at least for this market cycle, we're at an extreme point, and effectively more and more people are just jumping to the bullish side and saying that markets can't go down. Who needs to hedge for risk when the central bank's there and got your back? Moving on to the put to call ratio. So this is in the options markets. And this is also positioned for nothing but upside. Everyone's loaded up to the bullish side of the scenario. But what you'll see is moving from one extreme between puts and calls. Obviously a put is where you're betting that markets will drop and it's a way to hedge. And so if markets do drop, then you can cover your put and mitigate or lessen your downside losses. Calls, on the other hand, is where you're expecting markets to go up. You buy it at a lower price, markets rise higher, and you can close out the trade and capture the growth in it. Right now, we are at extreme, at least through this period. You'll see that this has become more and more extreme bullishness. But interestingly enough, on the flip side, the extremes have also increased as well. So once again, this was January 18, December 18, this was March, and this is where we stand today at these peaks. But you'll notice when we do hit these peaks and troughs, they do line up a lot of times with peaks in markets. So if we're at an extreme portion here on the put to call ratio, the reversion to the mean or the move in the other direction back to the average means obviously markets to decline and come back down to reality. Getting back to Gamma, Gamma is an offshoot from the options trade arena. And we've already talked a little bit about what Gamma is itself, but once again, showing the same thing is that this was the former trading range and the impact of Gamma on the markets, or the influence of Gamma, up until mid-2017 or early 2017. And now you'll see how extreme these moves have become. None of this is indicative of a stable market, and we'll show the actual market structure in a minute as well. But right now, I mean, this was February of this year, and then we had the crash in March. We got to August. These traders are on a hair trigger. I mean, look at how quickly, just from August through September and back up to the all-time extremes already, because they know that there's nothing fundamental holding these markets up, and they are quick to flip sides and positions on any given second or moment, especially given all the robo traders and artificial intelligence, the AI algorithms and such that are out there. But just understand, records are records or extremes for a reason, because once you hit a record, it could be a long time before you get back to it. Or more so, as I said before, the reversion to the mean could be, as we saw in March, very disastrous for portfolio wealth. So with all these extremes, this is what, off the March lows, it's pushed. This is the Dow Jones Industrial Index that we're looking at here. A Northman trader, this is Sven Henrik. He's a technical trader that I follow extremely closely, along with all the, the strategy that we run ourselves. But you'll see on the way down, you'll see these gaps that occurred. There was a gap here right off the top, more gaps here, and gaps. So this is what happens when markets move overnight in an extreme fashion, and they actually open lower or higher than the previous day's close. And so you'll see these gaps, they all got covered and filled on the way back up. And that's the story of this tale, is that gaps, not all gaps fill, but the majority of them will at some point. So now when we look at this recovery in the markets and the technical structure, each one of these blue bands are open gaps. So we've got a plenitude of gaps to be filled just purely without anything else being considered, just from a technical basis. You've got plenty of ammunition for downside moves to retest and cover some of these gaps all the way back to the lows in March. But as this says, the market has been working really hard to convince everyone that nothing matters and that things are different this time. Well, they have to be, because there is no technical history that suggests that this many open gaps are sustainable without some backfilling, without some backing and filling, none. This guy is on point with his calls and his analysis, and it's why I follow him a lot. But so there's a technical peer review of downside risk. But getting into a reason why could that risk actually occur? Now, this is what I showed in the email, the reminder for this seminar, and the market alert that I put out at the start of the week. So this is the VIX chart. What this is the volatility index. And so anytime you hear Wall Street put out warnings saying, oh, there could be some quote unquote volatility ahead, what they're really saying is market losses. But Wall Street is never going to use the word losses, because they don't want to wave their arms around in a startling fashion inside the chicken coop, because you don't want to startle the hens out of their complacency. So they use the word volatility instead. But it is a contrarian or inverse relationship to the market. So when the markets crashed in March, the volatility index spiked higher. And then, but what I want you to look at is the structure of this. So you'll see back in late January, this volatility index popped higher in January and stayed at a higher level, which indicated that there were increased pressures that stayed and remained in the markets, and then everything blew out higher. And then as markets recovered, this has come back down, but you'll see where the previous low average was. You'll see in late August, this spiked higher again, and it has stayed at a higher level on a consistent basis, and it looks to be starting to push higher. So this is indicating, and this whole period since March, this was before March, virtually no volatility, and this is what's been in the pressure and the problems and the stress has continued in the markets below the surface and behind the scenes since that March drop. We've stayed at these higher levels. When we look at the weekly chart, it's a lot easier to see these trends. This was that poke higher in January, and then this was the spike into March. But right here, you see this very clearly, how this separation from the lows and how we've stayed higher and are turning higher, with the trend indicators moving up as well. When moving to a monthly chart, so each one of these candles is a 1 month period, look at the 2007 into 2008 period. You saw a spike higher, stayed higher. We kept bouncing higher each time we reconnected. But more importantly, look at this, the Bollinger Bands and this middle blue line. So it was continuing higher and providing support in an upward trajectory, so that each time the volatility index came down, it bounced off it and spiked higher. Interestingly enough, look what's happening at the right-hand side of this chart. That same upward inflection of the middle blue line, including the upper and lower bands, basically creating a channel higher. So if nothing changes, as I said in the email, if nothing changes drastically, all this is indicating that there could, that there is support here, and that we could be looking at another supported volatility event higher, hence a drop in markets again. So specifically speaking to that potential drop, so Sven Henrik's wife, I believe her name's Malia, and he himself will say that she is much smarter than he is. But in late 2019, she put out a call for a massive push higher in VIX into the 80 to 90 range. And Sven would say that he thought it was kind of crazy to make such an audacious claim. But she said that this push higher was going to occur in the first quarter of this year. And guess what? It hit 85.47, right within her range. Here was that peak back here. Now, just last month, she has put out another call that the VIX would have another massive thrust higher in the fourth quarter. The fourth quarter just began on October 1st. We are in that period. And this is that same daily chart that I showed you before, but what this is a technical pattern. So you'll see it's called a head and shoulders pattern. You'll see that, it's the inverse head and shoulders. So, imagine someone standing, doing a handstand. This is their shoulders and this is the head. But this is indicative, as long as this structure keeps playing out, that this is supportive for a thrust higher. And here is the risk zone that she is calling for. And we're getting back up to the same sort of levels that we saw in March. So as long as this structure holds and continues to push higher, this is the more than likely the end result and the outcome of all that, which means another massive move lower in the markets. So getting back to Sven's work, looking at the S&P. So you'll see this is called an expanding megaphone pattern that's going on. Now, this pattern was at a lower level previously, going through these lower trend lines. You'll see it would hit that trend line and reverse, hit it again and reverse. But in this period right here, Sven was calling for the danger zone below to go down and retest this lower trend line at some point. Now, in September of last year, which was right here, this is when we had the overnight repo crisis in the banking arena, and the Fed started pumping massive amounts of money into the banking system. And that's what created this extended move up into February of this year. So this reset the upper trend line to a higher level. But then what happened? Markets turned and burned and everything went pear-shaped, and guess where it struck? It hit the lower trend line. $3 trillion later, along with other central banks, and guess what? The upper end zone. It hit the upper trend line and rejected. Now, yes, this is a little dated, but this has now since recovered a bit, but now it's rolling over again, as we saw on that earlier chart. But bottom line is, he is now saying that the next downside danger zone is another reconnect with this lower level, which would put it in the 2,000 to 2,200 level. Now, remember, back when we were talking about the earnings per share situation, that was indicative of the S&P being at about the 2,000 level. Here's a technical picture saying that, once again, that 2,000 to 2,200 level is in play for downside risk. So if that volatility index does jam higher, then markets go lower, and we're right in the game, in the ballpark, to hit those levels. Not to mention, Bank of America just recently, and I posted this on LinkedIn, the article, but Bank of America put out a report saying the S&P index could end up somewhere between 2,200 and 4,000. Now, to start with, That's what you call market analysis? That the high could be 4,000 and the low could be 2,200? Well, what that's really called is CYA, cover your assets. Because no matter what occurs, they can stand up and put their hand up and say, hey, we told you it was coming. But my goodness, those are your two outer edges, but still their lower end target. Once again, that's the third time we're seeing that lower end in that range. So buyer beware in these markets. So, looking at our funds and how they've been doing it through all this craziness in markets, our conservative total return income fund, which we started in August 1st of 17, is the orange line. The gray line is the broad equal weight US market index. So just to preface that, the S&P is market cap weighted, and currently the 5 big technology companies make up 28% of the entire performance in the S&P. We don't compare ourselves to a technology index. The equal weight US index is broadly diversified and equally weighted across the US markets and represents what your average investor's portfolio performance would be. But start to finish, our conservative fund is up 10.5%. US markets are down 9.5%, which means it's beating by 20%. Our moderate fund, same period of time from August 2017, is up almost 6%, with the markets down 9.5%. So our global opportunity fund is beating US markets by 15.5% because we protect from the losses. That's the difference in what we do, which is especially obvious in our US equity fund, which was started 1 year later, August 1st of 2018. We protected from losses in 2018, get the growth, protected from losses in March, get the growth. That's what we do as far as our underlying strategy. But start to finish, our US fund is up 13, while the US markets are down 16 over that same period of time. That's a 29% beat right here between the two, apples to apples comparison. Then our international fund hasn't been doing as well. International markets compared to US have not been doing as well, but still a head-to-head comparison, that is a 17, almost 18% beat because of avoiding the losses. Now, we did just start a managed S&P fund. So this is 100% of the assets in the S&P or 100% in cash. And we just started this on June 1st of this year. Now, we got in early and got out. Bottom line is we just haven't had a good entry point to really get this fund going. And so we did get an entry and a quick exit right here, and it's currently down 2.5% against the broad markets up 12. Not worried about it. It's a short period of time. These markets will roll over and drop lower. Currently sitting in cash on all 5 of these funds. Actually, we did get 1 or 2 positions back into the conservative moderate just recently here. But overall, the majority of it's currently sitting in cash on those 5 funds. But going beyond those generic sort of investments, what about gold? Everyone's been talking about gold and inflation, and gold's been on a run lately. But looking at this, Jesse Felder of the Felder Report, talking about the prospects for the value of gold. And he said, looking at the gold to Dow Jones Industrial Average ratio, gold does not seem expensive at all. And in fact, to match the valuation peak it reached just a decade ago, gold would currently have to double again from its current price to get back to those levels, let alone look decades ago back to 1980. Imagine the upside to get or the downside in the stock market itself to adjust this ratio and get gold back up to either one of these 2 levels. Goldman themselves just today came out and they said they see gold hitting 2,300. But an additional factor in talking about extremes, Jim Rickards he's a gold expert as well. He's saying that gold could be going to $3,000 or $4,000 an ounce. But looking at this chart, it shows this is your long-term treasury bonds, and currently there are extreme historical shorts on the bonds, meaning that everyone's betting that US bonds are going to crash and that yields will go higher. When everyone loads to one side of the boat, generally the markets trick everyone and inflict the maximum amount of pain on the maximum amount of people possible. So if things don't turn out the way that investors are heavily betting on, and this turns higher, that means yields, bond prices go up, yields drop and head back towards zero, and that is very positive for precious metals. So given that, we do have a precious metals fund that we started as of June 1st. Currently, from that period, started out at a loss, and then we got the opportunity to get some market run up. It's up 13.5 against the market's 12.5. So it's performing about the same level, but it's currently in cash and been avoiding the losses that are occurring in markets currently. What about Bitcoin? So surging, a couple of headlines of late. Surging Bitcoin volumes signals increasing institutional interest. In addition, Bitcoin surges above 12,000 as PayPal confirms a crypto service. As of today, I think we're beyond. We're into the 13 to 14,000 level on Bitcoin now, but still, Paul Tudor Jones says the Bitcoin rally is just in the first inning, and we still have a long way to go. And here's why. What this is a stock to flow chart on Bitcoin. This colored line here, this is going all the way back to the inception of Bitcoin. But this is the movement of price. You see, this is a multitude factoring price increase on the left-hand side here. So these aren't all same values of price movements. They're multiples. But you'll see that this red line is the projected pricing of Bitcoin. And Bitcoin just had a halving this year back in May, which means that what previously would have used 100 kilowatts of electricity to produce one Bitcoin, now that same amount of electricity gets you half of a Bitcoin. So it's making the Bitcoin more scarce. And when you have economics 101, supply and demand is there, but the supply reduces, just like pulling gold out of the ground, then there's the potential for the price to get pushed ever higher. And given this stock to flow modeling chart, the next indicated higher price target would be from I guess about 14,000 now up to 100,000 by the middle or end of next year. That's almost a tenfold increase. And you'll look at these color patterns. We're into the red right here, and the red turns to orange, turns to yellow, red turns to orange. Once again, I'm just saying, if this stock to flow modeling chart holds true, then there's plenty of upside potential in Bitcoin, and hence we have a Bitcoin fund. Started June 1st. Obviously, we started with a little bit of a loss once again, but then we caught a tick higher. We moved to cash, avoided losses, and we got back in recently. This shows a 20% to 12% beat. Reality is, as of today's close, this Bitcoin fund is now up 40.5%. compared to the markets at about 12. So this is what our strategy does. We get the growth, avoid the loss, get the growth. So this is a new area of exposure that we have available for clients. What about inflation in general? So our commodities, the new trade. Goldman Sachs says it expects a bull market to emerge in commodities into 2021. So what this ratio chart is showing is the relationship between the S&P commodities index and the S&P 500. Now you'll see when you get to the upper ends of this ratio, this is when stocks have crashed and commodities have either run up or they are relatively high because stocks have crashed lower. On the low end, this is when stocks are overvalued and overpriced and commodities are undervalued. And this is where we stand. This was just through the end of 2019. Now, through this year, this has actually started to turn, and we're starting to see inflections higher in a whole range of commodities so far this year. And just think about food banks and food shortages, China having to order more grains and wheat. Stay away from politics. Just think about the actual core nature of the commodities and what is actually being traded and used, and the US dollar declining as well, which pushes commodity prices higher. So once again, everything reverts to the mean, and this would be, as if you can believe Goldman Sachs, I've been calling for a while, waiting for this upward inflection and for the bull market to start in commodities. And hence, we do have a commodities fund that we are starting as of November 1st, I should say. So that will be online and available using the same trading strategy. And then we also have a cannabis fund that we are starting on November 1st as well, as in the specialty category. So those are all the fund models. These are all, invested for growth and then mitigate losses and move to cash to avoid the downturn, so that we're locking in gains on top of gains on top of gains. The last one we have is our long, short, all-weather fund. So this is betting short on US markets. As you'll see, when markets crashed in March, this one shot higher and had massive performance. Obviously, this has been a use a better term, a really difficult market to short, with stocks being blown into the first bubble ever inside a recession. However, during this period, this fund was only 100% short on US markets. As of the June-July period about here, we actually moved it up to 300% short. So if you're inclined to think that these markets are going to adjust back down to reality and crash, and then therefore looking to benefit from a crash in markets, being 300% short, then if we have similar sort of downturn, we would expect triple this sort of performance as a potential upside target with the current allocation. So that covers all the different funds that we run, how they're doing, where some opportunities are, what's happening in the markets, and the structure and problems and pressures and stresses and issues that are out there. One final thing to remember, that I've been, in our last quarterly update, I showed this same chart, and that I had said at the time, back early in the year, that the S&P could eventually and very easily hit the 1,200 to 1,400 range at some point, and here's why. The orange line is your corporate profits after tax. The blue line is your S&P. Now you'll see in the dot-com bubble, stocks ran up massively higher into a bubble while the economy stagnated and went into recession, and then stocks adjusted back down and the two lines reconnected. Sure, there was an upward move in profits, but they did reconnect. Then you had the 2008 crash, but then since then, look what's happened. We've had another similar dot-com style bubble and disconnect from economic reality, but corporate profits had gone nowhere for a good 12 years, 10 to 12 years right here. What's that? 2010 up to 20. So I guess about 10 years, 9 to 10 years of flat corporate profits, while the stock market, quote unquote, multiples kept expanding and have blown this massive bubble. With what happened in March, look where corporate profits are now. If these two reconnect, then currently corporate profits are sitting around that 12 to 1,300 level. Now there's a multiple of things that could happen. Could this adjust higher a bit? Could these two reconnect somewhere in the middle? Could this inflect higher, as we've seen in some of the charts, and then roll over into a depressionary environment and ultimately force the markets to drop to those levels? Anything's possible, but right now, markets are completely disconnected from the economy, and the economy is in very serious situation. So that concludes our presentation today. If you have any questions or want to follow up on anything, here's my contact information. You have my cell phone there, my email address, and our website. And this webinar will be posted on our website under the Market Updates tab, and will also be posted to our YouTube account under HK Wealth Management Inc. is our YouTube account name, and so we're also posting there as well. So if you want access to this presentation and go back and take more time to look at anything, it will be made available in both those areas. And like I said, you can always reach out directly and forward any questions to me, and we're more than happy to jump on a Zoom meeting or on the phone, and we can talk deeper about anything you like. So that concludes everything. Thank you so much for attending, and we will see you again sometime here in the future.